Everyone, today we are going to be looking at Disney stock. But first, I just wanted to say thanks to the four more people who decided to subscribe. If I can get the thing up, I will show the thing. So, plus 11 this month, which is pretty neat. So thank you for that. If you're watching this, make sure to subscribe. We're going to go over Disney's financials. So let's just get right into it. So, I mean, you could kind of see here, I reviewed it earlier and then recorded it. And as I was about to finish the recording, a person walked in and then I was like, oh crap. So I stopped the recording and then I looked at it and none of it saved anyway. So I guess they saved me a little bit of time. But anyway, this is the review for Disney. So snapshot looked okay. Cost of capital is fairly low. Target price is above. Long-term growth rate is good. Let's just get right into the income statement. So sales are fantastic for them. Consistent growth. Operating income, same exact story. Net income is a little shaky, especially with last year. They actually made significantly less than the year before for net, and then projected to outperform this year. So I still gave them full credit for that, only because they're projected to outperform and then some. EPS is consistent growth. Total shares, it looks like they were slightly declining, but if you compare it to what their old performance was, where they were really heavily lessening their shares, 1.7 billion down to 1.5, and then they diluted a lot up to 1.8, and now they're a little bit higher. So didn't give them the credit there. Let's check out the balance sheet. So cash situation is solid compared to their short term. That's pretty decent. Not really too much to say there. Assets are consistently increasing, not by huge amounts, but they are increasing. And also considering it's mostly a media company, I mean, that's pretty solid amount of assets. So short-term debt is fairly low, fully coverable by the cash. Their issue is in long-term. Now, I gave it the 0.5 here only because you can see it was all the way up at 55 billion and is down to 45 now with 4 straight years of decreases. So that is some really solid progress, and I like that. And then retained earnings, they have billions and billions of dollars of retained earnings. So nothing too crazy there. For cash flows, they outperformed everywhere. Operating, consistent growth. Investing, consistently negative. Financing, consistently negative. And then their free cash flow is positive and increasingly positive. They're supposed to have very high free cash flow this year. We'll see if that actually does happen. But considering the year's almost over, that's most likely locked in there. For their use of cash, they have been repaying a lot of debt, as we covered earlier, especially over the past 3 years. A lot of debt being repaid, very little being issued, which is really nice to see. In terms of dividends, I believe they had a dividend and they halted it, which is not great. But I mean, you could see it did kind of help with their cash situation, where their cash on balance sheet is better. So they're saving money doing that, but at the same time, it kind of lowers investor confidence. And then in terms of equities, they have only been issuing for the past 5 years. Not a crazy amount of money, at least for them, not a crazy amount, but still it adds up. Now it has been decreasing, but again, you could see the big zero there. Not decreasing enough to where it's negative, which is what we want to see. So onto the ratios. This is the first video where I added the SGA to sales ratio. I'll show that right here. So what I'm looking for is decreasing or consistency with sales growth. So basically the same exact thing as the net margin. So you can see it has been decreasing for 3 years and it has been fairly consistent over the past decade or so. So full credit there. Their net margin, while it looks like it's fairly stable, especially considering their sales are growing, used to be way higher, 15, 16, 21% in 2018, way higher. And now, for whatever reason, 2020, they went negative, they lost money, and now they've had 3 consecutive years of much, much lower. So, did not give the credit there, even though technically it's stability with earnings growth. I get that, but it is nowhere near where it used to be. And considering while Disney has done some things recently to kind of revitalize their profit growth and everything, you would think that like the switch towards more high profile TV shows and higher production movies and things like that over the past few years would kind of increase their net margin, but it really hasn't. So big negative there. ROA and ROE, I gave the 0.5 to, because while it is consistently positive, it also, once again, is nowhere near where it used to be. But a little different from net margin, they are a very, very mature long-term company. So ROA, ROE, it's more important for it to be positive, in my opinion at least, than growing. I mean, growing is important, and we would like to see some growth on it soon, but its positivity is a little more important. So I gave the half credit there. And then the debt to equity, again, 4 straight years of decreases. The only thing I didn't like was it is still fairly high. They have a ton of long-term debt, and it shows here with how high the ratio is. So I just don't really see it being the craziest thing. Now, also, you have to remember this is a percentage. So long-term debt divided by the total equity is basically what percent of their equity is their debt. So 45%, now that they're below 50%, it is actually pretty good. So thinking about that, I may actually, considering a decrease down from 66%, which is not the greatest position to be in, I'm honestly thinking of giving that the full credit, just reconsidering that. So for Disney, total score 19 out of 23, final 73.5, pretty solid score. Let's put that in here, 73.5. So pretty good score for Disney. Little above average for what I've reviewed so far, I think. And yeah, that's about it. Make sure to subscribe, and I will see you in the next one.